Hey, what's going on, everybody? Welcome back to Bonafide Investing, where we talk all things high yield investing, as well as futures, options, and really just investment goals in general. If you're new to the channel, welcome. To give you a little bit of background about what we're doing here, I've basically been experimenting for about the past year and a half on high yield strategies and just how to pay my bills through it and also maintain and pay down the margin that I use over time as well. So one or two things will happen. This will succeed. I'll keep adding money to it, or it will fail and I will go back and do something else. But please like and subscribe. Please help support the channel. Everything done here is never investment advice. Not now, not ever. And even when we do talk about topics like taxes, it's never tax advice. Not now, not ever. So please keep that in mind. Do your own due diligence. And before you ever invest, just please do your own research. So what I want to talk about today, I just put out a video on budgeting, and what I want to talk about now is investing. This is kind of going to be an investing 101. Okay, so whether you're new to investing, you're a seasoned investor, somewhere in between, just want to talk about what cash flow life, what this does for me on the investment side, and then see if it resonates with you or if there's just a better strategy out there. There are always things to consider. I think risk tolerance is a very important piece of the puzzle. I am, very risk averse. I don't like taking a lot of risk. And so what cash flow life has done is I hedge it, right? I hedge it through a lot of long puts on the indices like the NASDAQ and the S&P 500. I'll speculate here and there. I think oil is going to have a good 2026. So I bought a couple long calls on USO and Exxon. And then I also have to be very mindful of other asset classes, right? We're not just, stocks, equities. We're not just bonds. We're not just precious metals. We're not just real estate. I think there's a place for many different asset classes across all sorts of strategies. And I think diversification is really important. Okay. And we'll talk about all these topics as we go today. So just to kind of break it down, there are many different ways you can invest. Okay. I mean, there's high yield, like I'm doing in Cash for Life, which again is just about a quarter of my net worth. So I feel like that limits my risk with this right there in and of itself. There's also growth. Okay. So you can just be a passive investor and, grow it over time, wake up old, and hopefully it's worth more than, when you started. There are, different asset classes. Okay. You can invest in bonds. You can invest in T-bills, you can invest in cash. There's risk in cash. Okay. So I'll just be right out of the gate here, very upfront that cash has risk. It has inflation risk. You're losing automatically 5% minimum per year holding cash. That's always something to consider. You can hedge it with T-bills or money market accounts paying, right around 4%. But at the end of the day, it's still a loss. Okay. So there is risk in cash. To kind of start things off in cash while we're on this topic, I am in the camp that cash is trash. I think cash is a horrible long-term hold. However, I do think that the dollar will not collapse overnight. I think it will stay the reserve currency for longer than a lot of people who are in the cash is trash camp, care to believe or admit. I think we'll probably have at least another decade or two of, dollar dominance over foreign currencies, right? Like the yen, the euro, the Swiss franc, what have you. And the reason I say that is because we still have the most liquid bond market. Okay. So until something comes along and really replaces our bond market, the BRICS just don't have the liquidity like the US has, right? So we're still about 65% of the global economy. Do I think that's going to change over time? Absolutely. Do I think we're in a bubble? Absolutely. In particular, AI bubble. So again, I'm not calling for a crash tomorrow. I think a crash is coming. So I think that's where cash could be somewhat valuable, right? As if we do have a crash, having some cash, having that buffer to not only pay your bills, but also to redeploy it when assets are much cheaper. I think cash could be a very valuable part of a well-diversified portfolio. Cash, I like I bonds. I've talked about it in the past. That's where I hold a lot of my I don't know, called an emergency fund. Somebody asked me the other day, why don't you just sell your I bonds, put it into cash flow life, and then use the margin buffer as an emergency fund? I think it's a great idea, right? I think there's truth behind that, especially when inflation is lower, or at least being reported lower, right? Where maybe the I bond yield isn't greater than what I'm paying in margin interest. I'm just not mentally there personally. I like the I bonds. I like having those. It's just my sleep well at night, um, emergency stash. And now, it is illiquid for the year that you buy them in. I buy them every January and they become liquid by the next January. I usually buy them at the end of January. And then that way they're really only tied up for about 11 months, if you think about it, because I can buy them close to the last day of January. And if I had to sell them right around the first day of January. So I just like it. I like I bonds because you're getting the tax deferred interest. You can use them for higher education purposes later, for yourself or dependents. Again, not tax advice, but I know there's some tax advantages there. So again, I just like that, right? I might, if I ever get through that hurdle, bring it over here to, keep the yield higher, right? And pay down the margin with it potentially. But for right now, I like I bonds. I hold the cash portion through SGov. SGov is the iShares Treasury bills, 0 to 3 month holdings. So that's going to track basically very short-term Treasury bills. My target allocation for SGov is 10% of cash flow life. I did buy KYLD and I'll be buying YQQQ here this week. So I don't think SGov is going to show 10% allocation. It's a little under, it's about 9.62%. But again, it's very stable. The only time I've really seen the price drop is when it goes ex-dividend. So that's really nice. So that's how I allocate cash, at least in this strategy. You might put some cash in the mattress. You might put some cash in money markets, T-bills, all the above. There's not a one size fits all solution, right? So SGov is great. It's highly liquid. What I like about it is I live in a very high tax state, California. And so I don't have to pay state tax on the distributions from SGov, which is really nice. Another area we can talk about too is bonds, right? So if you want to do high yield investing, growth, riskier, conservative, TLTW, I think is a good holding for bonds for a high yield portfolio. You can also hold TLT or an equivalent like a BND or an AGG, which are aggregate bond funds. But what TLTW does is it gets exposure to long-term treasury bonds, 20 years plus. So what's its main risk is interest rate risk. And I do think interest rates on the long end are going to go up even as the Fed cuts. We've got a huge debt problem. We've got, just the deficits are not repayable because math. I don't know. I don't see any way around it. So I think the dollar will lose value because the Federal Reserve can't stop printing, right? But I think the bond market from a risk return perspective with kind of this potential everything bubble forming around AI, and now maybe potentially in, some precious metals, some commodities, as well as, even some parts of the bond market. I still think from a risk return perspective, the long bonds are not a bad place to be. So I try to allocate 10% to TLTW. And like I said, if you're more in a growth piece of things and you want to hedge with some long bonds, you could always explore like a TLT, which you won't get the high yield, but it's going to track the long treasury much closer. So, my grandmother and great grandmother, great people. They were from the Great Depression era. And, when I started investing, when I was much younger, I was always around the mindset of buy a house, pay it off as fast as you can, have gold, have cash, if not in your mattress, right? Or at least very liquid, accessible quickly. I think it's because what they lived through and what they experienced. So it wasn't necessarily a scarcity mindset. It was I call it maybe just a little bit of fear, right? And I guess until you live it, you can't really understand it. So a lot of people who are new to investing, right? If you've been investing since 2009, I don't think you've had your humbling moment yet, right? And I think what I like about markets is they'll always keep you humble. I don't care who you are. You got to stay humble as an investor. You got to always keep learning. You got to always acknowledge that, hey, maybe what I think is the way is not the only way, right? Matter of fact, cash flow life, I would never recommend anybody go out and put all their net worth, life savings in cash flow life or a similar strategy. Absolutely not. I won't. I probably never will. This sole purpose is to pay my bills, maintain and pay down my margin over time, keep me being able to do things like volunteer at my kids' school every day, pursue hobbies, travel, not answer to a boss. Now, I also want to stay in the mindset that I never want to stop working and learning and building my skill set, right? If I lost all my net worth tomorrow, you got to go dig ditches or do whatever, right? Nothing could be below you. Nothing should ever be beneath you or that you're too good for something, right? So always stay humble, no matter what you try. I've owned hundreds of these different ETFs, right? Through all these asset classes, bonds and cash, equities, gold, real estate, high yield, right? And I've kind of narrowed it down to just, I guess, what I like, just preference. Maybe it's the manager, right? You got different managers out there like Roundhill, YieldMax, Neos, Rec Shares. I don't tout one over the other. I see flaws in all of them. I see positives in all of them because, again, there's no such thing as a perfect strategy at the end of the day. Some investors might even want to invest some growth, some high yield. I see nothing wrong with that. That's also a good thing. But at the end of the day, you got to figure out your why. Why are you investing? Is it to do what I'm doing, cash flow life, or something similar where you just want something to pay your bills, live free from 9 to 5, do it that way? Do you want something to supplement your income, right? Where you love your job, so you don't want to leave that, but you also want some extra money to travel or, do things you want to do, or just stash more investing money away for a rainy day. You got to figure out your why when it comes to investing. So if you haven't started, and I guess this message is for those who haven't started investing yet, what is your why? Why are you investing in the first place? Because if you don't know where you're trying to be, right, you're just kind of throwing your money in a dartboard and hoping, I don't know, something works. So have your why. It's going to be very confusing, and I think it's stressful if you don't know why you're doing it. So establish that first and foremost. Now, when it comes to risk, markets move historically 70% of the time they move sideways. My favorite kind of markets. 20% of the time markets move up, and 10% of the time markets move down. Okay. So with those stats, I've had people say, "Hey, why don't you just put everything in, and why are you hedging, and why do you worry about the downside?" It's because when markets fall during those 10% of the time, they fall hard, usually in a ratio of 4-1 versus going up. Okay. So consider that. I've always said that, markets take the escalator up, the elevator down, right? The market eats like a bird, craps like a bear, however you want to put it, right? You can say it however you want, but that's the truth, right? And a lot of times markets will fall and they'll take a long time to recover. What's interesting is when this whole bull market started, arguably the shorter cycle piece since 2009, we've had, I wouldn't call them flash crashes, but we've had like 20, 30% sell-offs, and we had a V-shaped recovery, right? I think 2020, April 2025, not too long ago, right? We had these things where the market sold off hard, made a V recovery. So everybody's mentality is just buy the dip, buy the dip. Buy the dip's fine when it works, but there's going to come a day when buy the dip won't matter anymore. And you're going to get people after 20, 30% sell-off, I think, and this is, again, my personal opinion only, 20 or 30% sell-off saying buy the dip, and the market's going to grind lower, right? Possibly 40, 50%. And if we ever test the lows of the 2008, 2009 bottom, we could sell off 90%. Now, I personally hope that never happens. I think it could. I think anything's possible. I think that between the debt, between the leverage, between, just so many things going on in the economy, all these people saying that markets can never go back down low, all this, I guess, I wouldn't call it exuberance. I call it overconfidence. Those are the times I think that we need to be extra careful. So I don't recommend many things. I just read the book 1929 by Andrew Ross Sorkin. Great book. I highly recommend it. Just a lot of, it's interesting, some of the rhymes, right? And I've been saying this for years, by the way. I don't know when the collapse is coming, if it's going to come, when it's going to come. Nobody knows that. I always say stay away from people who will tell you. But I personally think that there's just so much froth and excess in a system that the Federal Reserve and government just have to keep printing just to service debts, I think that we could potentially get some sort of, depression meets a hyperinflation at some point in the future. Tomorrow, probably not. But until we get back to, I think, sound money, real money, and a healthier system, I think that we just want to be very mindful of risk. So I think whatever strategy that you deploy, that you decide to invest in, just always be mindful of risk. I like to hedge downside over growth first. So in my mind is need over greed, right? I want to make sure that, okay, how much can I lose before how much can I gain? You'll hear me say it on repeat. So what I do to hedge, again, there's many different ways. You can sit in cash. You can buy puts. You can invest in alternatives like gold. I'm a huge fan of gold. I have been. First investment I ever bought over 20 years ago was gold. And what's nice about gold is there's just so many ways you can own it now. You can own it physical. You can own it physical and store it in your own vault. You can store it in someone else's vault, right? You can own it through, I'd say, pretty reputable ETFs like GLD and IAU. You can also own covered call ETFs even that will sell calls on GLD, right? IAU, and even GDX, the gold miners ETF. I like all of it. I do. I think, you want to spread out the diversification. I had an interesting conversation. Someone said, hey, I've got Walmart, Johnson & Johnson, Coca-Cola. What was the other one? Like Procter & Gamble or something like that. All great companies, all companies that I think will survive the next potential Great Depression as well. But their diversification in their mind was, I own 4 companies in different sectors doing different things. I'm diversified. It's no, you're diversified across equities only. You're not diversified across all different asset classes, right? So if you look at that risk, what are the risks? Well, for bonds, you've got interest rate risk, you've got inflation risk, you've got default risk. Now, I know the U.S. has never defaulted on its debt, but who knows what the future holds, right? We've come to the point now where our debt is not going to ever be able to be repaid, right? So there's that potential risk. What about cash? Cash, the biggest risk, I think, is inflation over time. Your purchasing power is just eaten alive. And if you haven't been paying attention since 2021, inflation has been pretty ugly, right? CRF, I think the biggest risk to a closed-end fund that tracks the index is just market risk, right? It is diversified. It tracks the index, but you're still going to have market risk. If markets sell off 50, 60, 70, 90%, that's a huge risk, right? WPay and YMAX. These are, WPay is slightly leveraged. Although they are diversified across, I think, some different asset classes, slight geography. They're still equity heavy and they pay high distribution. So you're going to have NAV erosion risk, right? Where every time that NAV drops to pay that distribution, that's going to drop over time if there's no growth, right? If the markets aren't going up. So I think these could potentially get hit double if and when markets go down, right? You might have the income, but in nominal terms, that income is going to fall. That's something you want to be mindful of. QDTE, QLDY, QQQI all track the NASDAQ, right? XDTE, SPYI, they all track the S&P 500. With the Magnificent Seven and all this concentration in the markets, the NASDAQ 100 and the S&P 500 have, in essence, become the NASDAQ 500, right? However you want to say it. There's a lot of overlap, and I think that we'll probably see a lot of rotation. But rotation isn't always good, especially when we see a steepening yield curve like we're seeing now. Bad things usually happen. So that's a lot of market risk. And that's why I buy those SPY and QQQ long puts to hedge those just getting completely obliterated in a market crash. And I also want to keep in mind that those high distributions they pay in nominal terms will fall also. They'll still pay. They'll probably still pay within the percentages that they're known to pay, but in much lower nominal terms if the share price falls, right? So again, gold. I think gold should be a piece. And again, how much do you want to hold, right? You got to consider percentages. Do I want to have 10% in cash? Do I want to have 50% in cash? Somewhere in between, right? Do I want to have 5% gold? Do I want to have 50% gold? These are things that you got to kind of figure out, right? And what kind of risk do you want to take? Silver's over $70, right? In nominal terms, is at its all-time high, right? Platinum just matched its all-time high from, I think, 2007. So, but if you don't own any, is it a bad time to add? Probably not, right? If you have a lot, maybe it's time to take profits, If you have the just right amount and you think the dollar will slowly die over time, then you don't really care about the price, right? It's a long-term hold. That's how I see a lot of it is, silver's had a great run up. I started buying silver in the single digits. I don't really care what silver does, right? It doesn't keep me awake at night if I miss, $75 sell and it drops back down to $50 per ounce. That doesn't bother me, right? I think I've said in past videos, when gold and silver go down, I actually get excited because that usually things that our living standards are generally getting better, right? Usually costs are coming down. There's less uncertainty. So I actually like to see these assets fall. So they're more insurance. The only time I use gold to generate cash flow is here in Cash Flow Life, right? This is where I like it to at least pay me a high yield to pay my bills and maintain this margin. Real estate. This is a tough one. I think if you own your home, if you rent your home, whatever that value looks like, that's something to consider. I personally don't like being a landlord. I don't want to deal with that. So I'd rather own something like IYRI. You also have V&Q, which is a Vanguard. It's a more passive approach, right? Where you can own high quality REITs and, just let them pay you the distributions. They have to pass through 90% or more of their profits as income to you to avoid their tax issues on their end. So they're going to usually pay out, pretty good distributions. IYRI just aims to just squeeze out a little bit more from those high yield REITs where you can own, access to apartment buildings, high quality commercial real estate where, certain stores are needed. So that's good. I think it's good to have that exposure. And I think if you're investing for growth or high income or whatever, I think that's a good place to be as well. And then again, I'm going to have my speculation plays like KYLD. That's, I'm going to make a video coming up soon here about KYLD, ULTI, some of my thoughts on the high yield space that I think we need to be mindful of as high yield investors, the pros and the cons about each of these. And then what I do, I like to dollar cost average back into the core. And I dollar cost average, I've said it before, is because I want to control for NAV erosion. I want to control for inflation, right? And I want to dollar cost average, and I have to worry about timing markets. I'm a bad market timer. I don't like to time. So dollar cost averaging gives me peace of mind that I'm buying every day, whether the markets are up, down, or sideways. It doesn't matter to me. So again, go back to your why, figure out, why am I investing in the first place? Is it to pay all my bills? Is it to provide some extra, cash? Is it to just have a nest egg when I'm old and retire? Is it to preserve what I've made? Right. I'm a firm believer there's a potential passive investing bubble forming or has formed, meaning the set it and forget it approach of the last 40 years, I don't think is really going to work well moving forward. So those people who were in a 60-40 portfolio or similar, where there were 60% stocks, 40% bonds, I'm not sure that's going to do super well, right? It could, right? But I really don't think so. I think we're getting back into an active management environment where what gives me a little bit of confidence with Cash Flow Life is a lot of these holdings are actively managed by the managers, right? They got to sell the calls, buy the puts, they've got to actively manage a lot of these holdings. So I think there could be a potential passive investing bubble forming where if stocks and bonds sell off simultaneously, like we saw in 2022, I think a lot of investors could get hit hard. 401k. I think there's a lot of risk in 401ks. I'm going to make a video about 401ks, and I'm not anti 401k, but there's a lot of risks that are never, I think, discussed or acknowledged within those accounts. And maybe we can talk about some ways that you can hedge a 401k as well. So there are some benefits to those investment vehicles. So again, no matter what stage you're on in your life, you got to figure, okay, I'm this many years old. How old am I? What's my risk tolerance? What is my why? Why am I doing this? Right. At least as a starting point, I think making a budget. My last video, I talked about budgeting. Okay. I think it's important to have a budget so that, okay, here's how much I pay in bills. Here's how much my job pays me or my portfolio pays me or whatever. I need to be mindful of, what's going in and what's coming out. So I've said it before, Cash Flow Life, I'm building my own pension. This is a business to me, right? You can look at it however you want. This is a business where I've got to be mindful of costs, right? I got to be mindful of my employees, my holdings. my costs of my business or my bills every month. What is my business generating in income? This is all the distributions I receive, right? How am I hedging inflation? What about downside risk, right? Businesses are subject to market risk, right? A lot of businesses will have to lay off or sometimes shut down when economies go bad. So how do I hedge that? So you've got to, again, figure out all these things. Love to hear your comments. Love to hear your thoughts. I'm going to make some other videos here. Hopefully this weekend. We've down here in Southern California, our weather past couple weeks has been very similar to Seattle's weather. So, a lot of inside time, a lot of downtime, which I think is just more opportunity to hopefully make some videos. But again, hope you got something from this video, and thanks for your time and have a great day.